So obviously housing downturn accelerates as falling values become more widespread. Now, just remember this is a national report, and then we'll talk more about WA, which is a majority of our membership, afterwards. So if you're not experiencing what I'm reporting, this is a national report. Okay, so CoreLogic National Home Value Index recorded a fourth consecutive month of decline in August, with the downturn accelerating and becoming more geographically broad-based, down 1.6 over the month. The national index recording the largest month-on-month decline since 1983. So for those doomsayers, that's what they're referring it to. Every capital city apart from Darwin is now in a housing downturn as far as the figures are concerned. Okay, Sydney continued to lead the downswing with values falling a negative 2.3. Brisbane accelerated sharply through August with values falling negative 1.8. So they've gone from up there to down there. Their curve hasn't been a curve; it's been a friggin' downhill. So there you go. That's Brizzy. Brisbane's shift into decline has been acute after almost 2 years of sustained growth due to record high international migration and relative affordability. So it was only 2 months ago that Brisbane's housing market peaked after recording 42.7% boom in values. That's insane, isn't it?
Yeah.
47% growth. So I don't think it's going to affect them too much by having a negative 1.8% growth downturn. So I think that was destined to happen with those type of rises, and you'll probably see consecutive drops for Brisbane. Okay. After recording significantly stronger appreciation through the upswing, the fall in regional dwelling values is catching up with capital cities. So you guys would start feeling this. Okay, the annual trend in housing values is rapidly leveling out. Okay, despite the recent weakness, housing values across most regions remain well above pre-COVID level. So there is a positive. Morning, Rich.
Morning.
Great to have you, mate. Home values in all capital cities and the rest of regions, bar Melbourne, remain 15% above levels recorded in March 2022. Okay, I'll say that again, just to give you a bit more understanding. Despite the recent weakness, housing values across the regions remain well above pre-COVID levels. Home values in all capital cities and rest of state regions, bar Melbourne, remain 15% or above the levels recorded in March 2022, implying most homeowners have significant equity buffer before the home is likely to be worth less than what they paid. So we're still in very good, positive growth territory. So we've got to, when we're looking at downturns, we've got to put it into context. So when you're talking to your buyers and sellers, okay, it's context. How much rise did we have? How much net gain did everybody add to their properties? Okay, how much has it dropped? How much negative deficit have they got on their properties? We're still way above where we were pre-COVID and in the downturn. So there's always positives you can take out of any statistics. All right, if you're talking to sellers, before listing, if you're talking to buyers post listing, and when you're talking to sellers post listing, the conversation can change. You can use different parts of this to get your point across. Okay. Mr. Lawless expected the downturn will continue to play out through the remainder of the year and possibly into 2023. It's hard to see housing prices stabilizing until interest rates find ceiling and consumer sentiment starts to improve, he said. From current levels, interest rates are likely to increase by at least another 75 basis points. Well, they increased 50 basis points already. And there is a good chance advertising stock levels will accumulate through the spring selling seasons, providing more choice for buyers and adding further downward pressure on housing values. Okay, so just looking at the change in dwellings, Sydney negative 2.3 for the month. For the quarter, negative 5.9. So annually, they are now showing a negative growth rate because their downturn has been going longer than anyone's. So they're in a minus 2.5 for the year. Melbourne negative 1.2 for the month, negative 3.8 for the quarter, and they're at negative 2.1 for the year. Okay. Brisbane, negative 1, as we said, 1.8. Quarter, a negative 2.5, but they're still showing an annual growth rate of 17.5%. And we saw this with Melbourne and Sydney a few months ago. Adelaide, negative 1, but they're still showing a quarterly growth of 1.6 and an annual growth in Adelaide of 21.8. Little old Perth, we did another negative 0.2, which makes us a 0.4% increase for the quarter, and 4.9 growth for the last 12 months, over the last 12 months. Combined capital cities, negative 1.6, negative 3.8, and still showing a 2.2% growth in the capital cities because of Adelaide, Brisbane and Perth. Combined regional, negative 1.5, negative 2.1, and 13.4 for growth, positive for the last 12 months. Combined nationally, and this is what's going to get thrown at you guys, all right, out there in the field. You're going to get these numbers thrown at you, but it's not really, sort of something that can be sort of looked at for everyone. Yes, it can be taken into consideration, but certainly every state, every suburb, stock levels, all that come into consideration. But the national report is minus 1.6, which I mentioned, and for the quarter, minus 3.4 for the quarter, but it's still showing a 4.7% growth nationally for the 12 months because of those because of regional and the smaller cities still showing annual growth, even though they're showing negative initial monthly growth. So theirs is still coming down. Okay. So let's have a look at stock levels. The trend in freshly advertised housing stock being added to the capital city markets was 13.4% higher than a year ago. Interesting, 6.5 above the previous 5-year average. So that really says that the stock levels have come up. 6.5 above 5-year average. So when we look at sort of statistics, we look at a 5-year average to get a sort of real sort of median or how we're faring. So 6.5 above is higher, obviously. So stock levels will continue to increase through the spring selling season, and it just depends on the absorption of the stock. Will depend on how it looks on the other side. Remember, this is national. Okay, rental rates increased a further 0.8% in August across CoreLogic National Index, but even the rent nationally, the rental growth nationally is slowing as well, because we've had some horrific growth in rentals, not locally but nationally, because locally it's still going ballistic. The outlook for housing market remains intertwined with the trajectory of interest rates. So interest rates obviously still a factor. Forecast for the terminal cash rate generally range from the mid -2% to the mid -3% range, although financial markets are pricing in a peak cash rate of just over 4% by August next year. Mr. Lawless said the range of forecasts for the cash rate highlights the sheer uncertainty associated with inflation, wages growth, and monetary policy. The silver lining to the lower housing prices is an improvement in some measures of housing affordability. That's what happens. Affordability slows, interest rates go up, properties become more affordable, obviously, and then the whole thing turns again, okay? Then people start buying houses again, interest rates come down. So that's kind of what's forecast. So we're already looking at the curve of the downturn nationally. However, mortgage costs and rents are rising and household budgets are stretched. With spring upon us, advertising stock levels are expected to rise, already mentioned. This is interesting. With labour markets so tight, the unemployment rate was 3.4% in July, and some momentum gathering in income growth, We are not likely to see material increase in the number of distressed listings or forced sales despite the higher interest rate environments. Once again, because people have got equity in their homes, so it's not as pressured as it could be if it continues for a year or two. Okay, the risk of housing stress is further minimized by serviceability buffers implied to borrowers as part of the loan approvals assessment. Since October last year, borrowers were required to demonstrate an ability to repay their debt under a mortgage rate scenario with interest rate 3%. Anita, the bell's going. Oh, sorry. Points higher than the current rate, 2.5% points prior to October. I'll say that again because I lost concentration. Since October last year, borrowers are required to demonstrate an ability to repay their debt under a mortgage rate scenario with interest rate 3% points higher. So people with new mortgages, okay, they've been means tested for a downturn with the prediction of a downturn, which is quite realistically happening right now. So the recent upswing is important context in the current downturn. Although housing values are on track to record a significant drop, the risk of widespread negative equity remains low, considering the substantial rise in housing values between September 20 and April 22. Good morning. National home values rose by 28.6%. So even a 20% decline in housing values would result in a housing value remaining above the pre-COVID level. Okay. So yeah, there's a lot of positives in that nationally, which I know most of you are not. It doesn't really affect us, the nationals, and that's okay. We'll talk about Perth in a second, but I'm going to talk about New Zealand because we do have a few New Zealand clients, and when they're watching the recording, they want to know what's going on in their neck of the woods. Well, they're in a complete free fall. That's it. Case closed. Only joking. New Zealand housing market downturn has accelerated in the past month, with the rate of falls in property values doubling month on month in August. Negative 1.8 in August, twice the rate of that seen in July, which was negative 0.9. The 3-month fall in values of negative 3.5 is drifting closer to the depths of the global financial crisis, when the rate of change bottomed out and a negative 4.4% at the end of August 2008. So New Zealand, New Zealand numbers still stagger me though. I mean, and I think the best way to explain it is just supply and demand. Like, it's a small place, there's low population, and it's a desirable place to live. It's got a great economy, it's got a great government. So New Zealand, nationally, negative 1.8, as mentioned, quarter negative 3.5. Annual growth still is 5.8. They had insane growth in New Zealand in the last few years. Average home value in New Zealand is 991,000. Auckland, negative 2%, quarter negative 4.6%, annual growth 5.1%. Average home price in Auckland is 1.405 million. Tauranga, negative 1.2, negative 3.3, and 11% growth for the year, 1.139. Wellington, $1 million average housing. Christchurch, 761. So they've got huge median house price in New Zealand, which is quite staggering. Okay, let's have a look at a little old Perth. Well, I reckon the market, I don't reckon, let's look at the stats. 945 sales last week. 8,160 properties on the market in Perth. That is a crisis. If that drops to 7,000 odd, I think the least I've seen is in the 6 or 7,000s, and that was like the major boom in 2005 to 2008.
Got down to 5.5.
Was it 5.5? But look how many more properties we have now since then. I mean, that was nearly 17 years ago. The zoning, the whole of Perth has been rezoned since then. So the housing numbers should have doubled, and we're still looking at, do you know what I mean? So it's actually worse off now because of our number of houses than what it was then. So So look, I can't see that affecting the national values. If you're in Perth, I can't see the national values affecting you at all. But you need to be mindful of them. You need to be aware of them. There certainly was a lull in July. I think everybody felt it. Buyers sort of backed off. This is when the first couple of interest rates hit. There was definitely sentiment from all my clients, all my coaching clients that said, market's changed overnight, like bang, no more buyers. But it seems to have kicked on. Everyone I'm talking to now is as you can see from, you know, the attendance, everybody's running rampant again. Obviously, stocks are the problem. Stock levels are the problem. And as long as I've got 2 feet on the ground, it'll always be the same thing. It's supply and demand. And when you've got supply at 8,150 and rentals at 1,905 available for Perth, my daughter has moved home with the cat, okay, because she can't find a rental. True story. She applied for 18 properties. I blame the cat. But anyway, we move on. Getting granddad next, great granddad next month, so that should be interesting. We'll have the cat, granddad, and little one. Little one's 25 now. So.
I'm looking for a rental.
Actually, little one's the baby. Yeah, Nita's moving out. I might come with you. You know when you pack your bags?
Yeah.
Pack mine as well.
And that little unit of ours comes available in Como. We'll take that.
Yes.
Okay.
Can we maybe get one each?
Yeah.
So look, look, it's spring selling season. You know, the sun hasn't quite come up, but it's peeking its head through the clouds. And, you know, we're gonna, there's no doubt Perth is going to have a great summer. You're going to have a great next six months, but it depends on what happens, you know, in the next 6 months that's going to tell what's going to happen. Personally, I see the Perth property market growing further. If you read my articles in the West early on, because I was asked to write a piece, I said growth this year between 10 and 20. And I said I would, if you wanted me to shorten that, I would say at least 15. Okay, we've already got 10. We've already had 10% growth in Perth in the last 12 months. All right, so so I reckon we're pretty well on track for potentially. But look, it's not about the growth, is it? It's about, for you guys, it's about supply. So we wanted to loosen up, I would think, because everybody's crying for stock. So the best market for you guys in Perth would be 11,000 properties on the market, you know, 10 to 11,000, because that's loads of enough supply without it causing, you know, like sort of downturns, and you've got you've got good absorption, reasonable absorption. You've got to work it. Properties are taking, you know, 30 to 45 days to sell. So you're having to work it, but you've got lots of stock. And that's where the cream rises to the top. You know, you've got those people who've invested in virtual assistants, or you've got people who've invested in admin managers and buyer managers, and people who have like support hubs, you know, and people who have got the support can actually tear through a lot of property. But right now it's tough. It's tough no matter what way you look at it, all right? Because there's just very little stock, okay? And that's what I'm getting from all my clients. So that means it's kicked on again, and I reckon we could have, where are we? September, October, November. So we got a quarter left, okay, of the calendar year. I wouldn't be surprised if we see a few percent growth before the end of the year here in Perth. What is everyone else seeing?